So in this video, I'm going to be talking to you about how to acquire cash flow producing assets to accumulate wealth. You might have heard about this concept from Robert Kiyosaki, who said you can create wealth by accumulating cash flow producing assets. And of course, in his scenario, he was talking about real estate. And in this video, I'm not going to talk about real estate because there is another class of assets that you can acquire that's far more profitable than real estate. And that class of assets is known as private businesses. So businesses which are privately held by small family owners, individual owners. These are not businesses which are in the public markets. Okay, we all have heard about the advice that all the savings that you have, you should invest in the public markets, in the public company. So when a company is taken public, most of the time the stock is overvalued. And most of the companies that exist in the market, the stock price is overvalued. And most of the shrewd investors that have made all the money investing in the public companies have invested in companies which were undervalued, not companies which were overvalued. And if you look at their portfolios, they have acquired few but really good companies, and they've held it over time, and that's how they've made money. So I'm not talking about investing in the stock market, in the public market, and I'm not talking about acquiring real estate. I am talking about acquiring businesses, but the businesses which are private businesses. For example, when you walk out the door, you see a grocery store, or you see a pharmacy that's owned by an individual, or you see a restaurant that's a company, as long as it's not McDonald's, because that's part of the chain, but an individual restaurant, that I'm talking about those types of businesses. So what I'm about to share will not work in every industry because the numbers would not make sense. So if you want to acquire a company with not your money, no money down, so no money out of your pocket, and you can buy a business, if you want those types of deals, those types of deals are available in certain segments of the market, not in all types of market. You certainly, most people cannot acquire a public company stock with, by raising capital. Very few people are able to do that. Most people can't do that. You can acquire real estate with not your money. You can use banks' money, but the return on real estate is not as good as, for example, a business. When you buy a good, profitable business, the return is going to be much higher, especially when the business exists in a healthcare market. So that's a little bit of a caveat that this is not going to work in every industry, and this is not going to work for all types of businesses, but this is going to work for businesses which are private and which are owned by families and which tend to have big margins. That's important, to have big margins. So if you have a combination of big margins and a small price that you pay to acquire the business, it generally works out. So let's break it down a little bit further. I just wanted to provide this disclaimer that I'm not talking about real estate, I'm not talking about the public market, I am talking about businesses. And that to specific kinds of businesses, which we refer to as boring businesses. Businesses that don't have the sex appeal that tech businesses have, or fashion businesses have, or large media companies have. These businesses don't have the sex appeal, but these businesses are boring businesses. They fulfill the need of the people, essential needs, and they're important businesses, but they don't have the same sex appeal as starting an electric car company, etc., etc. So these businesses could be in healthcare, for example, a dental practice or a home care company where you have an office that sends nurses to patients' houses, and those types of businesses I'm referring to as boring businesses, businesses that lack a little bit of sex appeal. So here is the thing. You have these privately owned companies that are owned by either individuals or families, and they are large in number. Okay, so in USA, some of my clients are doing this right now. In USA, they did some analysis, some of my clients, and they say that there are over 30 to 40,000 businesses in home care and also in dental. So you have a market which has about 30,000 privately held businesses in the USA area. USA alone, this is not global data. So just USA alone, you've got 30 to 40,000 businesses. And most of these businesses have big profit margins. So these are profitable companies owned by individual families and, owners, individual owners. And they have been running this business for 20, 30, 40 years, some of them. And a lot of these owners are getting old and they don't have a succession plan, meaning they don't have a way to sell their business. A lot of the people are buying houses and selling houses, but how many people do you know that buy businesses? How many people in your family, relatives, friends that you know about that buy businesses? You have a very rare case of scenario where somebody's going out buying businesses. Of course, you're watching this channel. You may have watched Dan Pena. You may be, surrounded with that community. But if you look at in your personal life, if you analyze, you would not know people who buy businesses, but you would almost always know people who buy houses. So houses are easy to sell. That's also an asset. It's your personal asset, your home, even a commercial real estate property. All of that's easy to sell. There are many websites where you can do it. But private businesses are a different matter. You need a lot of expertise on your board to be able to evaluate the business, analyze the business, structure the deal, finance the deal, and manage the company. Because business is not a hard asset. It's more like a soft asset. What do I mean by soft asset? So real estate, the main value is in the land and the concrete and the location, right? But a business's value is in the customer base, the employees that the business has, the products and services the business offers. It's an ecosystem. What you're buying is a moving piece of puzzle. You're not buying something that's static. It's easy to manage something that's static, stable, doesn't move, versus a business that's dynamic in nature. It's a cash machine. And it keeps moving and it keeps changing. So it's like a beating heart. It needs management. So a lot of people don't acquire businesses because it takes management to run this. Not everybody has the expertise to manage it. Of course, you can have the expertise to manage it on your board. You don't have to know. Somebody on your board can know how to manage these businesses. So because it needs management and a lot of the time, a lot of expertise, that's one of the reasons what stops people from buying businesses. General public buy houses, but they don't buy businesses. But businesses have a lot of cash flow, and their cash flow, especially in healthcare, is much more than real estate. So there is an opportunity that most people don't have expertise to capitalize on. And here the cash flow is low, but people have the expertise to capitalize on. So they tend to go to real estate because it's familiar. And you have this whole array of opportunities within the area of buying businesses that is untapped, because people have this belief that you need to be a doctor to acquire these businesses, or you need to have some level of industry expertise yourself personally to acquire these businesses. So people generally don't buy businesses, small businesses. And as a result, what you have is an old owner who has a profitable business who can't sell this business to anybody because there isn't a market, just like real estate, where there are lots of buyers for real estate, but there aren't as many buyers to buy a business. And what you have is a lack of a base of buyers. And when there is a lack of base of buyers to any commodity, the value of that commodity goes down. Although the commodity is valuable, but the price of the commodity goes down. So there's a valuable commodity, but the perceived value goes down and the price goes down. And this is where we come in. We come in and we make an offer to the seller and we acquire the cash flow producing assets. I'm going to be getting into the deal structure. I'm going to give you a sample of how the deal structure would work. But I just wanted to create a basis as to why these companies can be bought at a low price. If you're paying low price for something that has a high cash flow, you could get that deal financed with a bank, just like a real estate mortgage. Just like when you go to buy a house, you put up a down payment and the rest of the payment is structured over time and you finance it with a bank, and you can either put that house on rent and you can pay off the bank with the rent money. Just like that, a business has a cash flow. So you can buy the business and the banks can be paid from the cash flows of the company. So this is not going to work on every industry. This is going to work for industries that have high profit margin and industries where the owner is old and is not able to sell the company and needs a succession plan and there are no buyers. Those specific industries, and they typically tend to be boring industries, you could buy these companies at a low price. When you buy it at a low price, you can finance the deal from a bank. How do you pay back the bank? The business is profitable, so you can use the cash flows to pay off the loan. And I'll give you an example of a deal. So let's say a business is making $1 million, $1 million in revenue. And the profit of the business is, net profit is $200,000. That's a 20% margin, which is a good business. Most of the healthcare companies have that margin, 20% margin. So the 200,000 is our profit. Okay, keep that in mind. 200,000 profit. The businesses are valued based on a multiple of the profit. So you can put a multiplier on this cash profit number and you will have the value of the company. So let's say you offered $600,000. So $200,000 is the cash flow. You multiply that by 3 and you have $600,000. That's the total value of the company. $600,000. And you agree with the seller that, listen, your business has too many risks. Okay, it's run by you and we can't pay you all upfront cash. So what we can do is we can pay you $300,000 upfront and $300,000 over time. And the seller has no choice because it's a motivated seller. It doesn't have any buyer. It's a very small business for any other buyer to buy. He makes a sad face and he says, okay, fine. You give me $600,000. Actually, I want $700,000. You give me $350 upfront and $350 over time. And you say, okay, fine. I'll give you an extra $100,000 if you do this. Okay. So now the value is $700,000 where you're paying $350,000, 50% upfront and 50% over time. Okay. So now you have to come up with $350,000. Okay. That's the price you have to pay upfront in cash. The cash flow of the business is $200,000. Remember that. So $200,000 is the cash flow. The initial payment is $350,000. You go to a bank, you say, I need a loan and I will pay over 5 years. Okay. The bank says, fine, we can give you the loan for $350,000 and you pay us in 5 years. Okay. So let's calculate what's the number, what's the payment every year. The payment is going to be roughly $70,000. If you finance the loan over 5 years, the payment is going to be $70,000. That's obviously without the interest. We can calculate the interest. Let's say with interest, it's going to be $80,000 to $90,000. Okay, let's say it's $90,000 with interest. It's high, but let's say it's $90,000. So you have a payment of $90,000 to the bank every year for the loan, but your cash flow is $200,000 a year. And you can agree with the seller that all of the 100% of the cash flow goes to finance the loan. You can have that as a part of your agreement. So now you are paying off a debt of $90,000 a year with cash flows of $200,000. And that's a very decent coverage. You can easily pay a loan of $90,000 a year from $200,000 of cash flow. And when you can show the bank that the business is actually producing $200,000 and the way you're structuring the loan, you will be paying $90,000 a year to the bank. Why wouldn't the bank not give you the money? They're going to make interest and they're going to get their principal back. The business is 20 years old and it's been profitable since last 10 to 15 years. Even after paying off the loan, you will still have some cash flows left in the bank every year. And once you pay off the loan, and you can easily pay off the loan early, I think you can pay off the loan in about 2 years' time. You can pay off the whole loan. And after that, once you pay off the loan, you can get a refinancing. Because once you pay off a bank's loan, the bank can loan you more money. So once you pay off this $350K, you can ask for more money. And with that money, you can clear the remaining 50%. Or you could use the surplus cash that's gathering in the bank and you can pay off the seller at a future date. So the bank is paid, the seller is paid, and now you own the business. So that's how you buy a company, and that's how you structure a deal. The challenge is to find a motivated seller who's really desperate, who's in his 60s or 70s, and does not have a succession plan and is desperate. That's the challenge. If you have if you have that sorted, that piece of the puzzle sorted, you can structure the deal that I just mentioned. And the numbers that I ran, I know people who have closed this deal, a deal like this, on these terms, the price and the deal structure. Okay, I'm oversimplifying it. There are many other finer points in the deal which has to be structured by a lawyer and a financial advisor. But I just wanted to show you using two metrics, the purchase price and how you use the cash flow to pay off the bank, how you raise the money from the bank and you pay off the bank. So the deal is self-financed. There doesn't need to be any cash coming out of you. The bank does not care, most of the banks, and this is something you have to negotiate with them. The bank doesn't care where their money comes from. The bank wants their principal and interest back. That's what the bank wants. So the bank doesn't care whether it's your money or it's coming from the business. And this model of acquiring companies like this is known as a leveraged buyout. You can Google it, leveraged buyout. And it's a very common way big investment companies acquire other companies. And entrepreneurs can create wealth by acquiring several companies. Just like how you create a real estate portfolio, you can create a portfolio of these private companies. Just like people have a stock portfolio where they own very small, minute percentage of a very large company. Instead of that, you own big pieces, big chunks of small, private, and profitable companies that are in stable industries, boring businesses. You can have a portfolio of these companies lined up and you can sell them together at a very high price. And you can sell them, if you combined about 10, 15 companies together, the cumulative value of those 10, 15 companies is much larger than if you had to just sell one small company. If you combine and create a chain of these companies, you can sell it for a much higher price. The classic example is a restaurant, an individual restaurant is not going to be sold as high multiple as a McDonald's chain, because a chain is more stable. It's a much larger company. The company who acquires it will experience a significant amount of growth. There is more demand for a larger company versus a small restaurant. For example, there is a much more demand for a chain like McDonald's to be acquired versus a one-piece restaurant, one unit of restaurant. So that's the basis of how you buy companies and you consolidate them, merge them together, and then you sell this whole portfolio at a future date in a couple of years' time and accumulate massive amounts of wealth. So once again, I want to emphasize, this is not going to work in every industry. This is not going to work in every deal scenario, every type of business. This is not going to work if you do it for public companies, because you can't just finance it with a bank in most cases. And it does work in real estate, but to do it with businesses is far more profitable than to do it in real estate. So that's how you acquire a cash flow producing asset if you want to create wealth. And if you're interested to learn this business model, if you're interested to execute this business model, reach out to me. I've got a mentorship program where I teach and train you exactly how you secure your advisors, find multi-million-dollar businesses, find the right banks, and connect the two. And obviously, how do you negotiate the deal with the seller? How do you find the seller? What do you say to him? And I've spoken to over a couple of hundred companies, and I've looked at their financials. I know how much money they make. I know what price they have agreed to sell on. I've negotiated several multi-million-dollar deals. I've structured them. I've also visited the banks. I've presented these deals to the bank, and I've also managed to secure a bank term sheet of that the bank was interested to finance. It was a $10 million business, and the bank was interested to finance 70% of it. We decided not to pursue that transaction because it had some legal issues. The company had some legal issues and some reputational issues, but the bank was interested. So I've been through the process. I know how it works, and I know several individuals who have acquired several companies with a similar structure that I mentioned. Of course, the deal structure, the price, and various terms are different in every deal, but I know several individuals who have done it. I have seen the process myself. In my scenario personally, I've met a lot of these businesses and I know how the process works. So if you're interested to get mentored by me, I've got several clients across the world who are doing this right now. They just started off as I started just consulting them. So they are in the initial phases of the process. And if you're interested, I have a couple of more spots open. The demand is increasing as the channel is growing. If you're serious about creating wealth, and if you're looking for a business model to acquire companies and create a portfolio of companies to be sold, reach out to me and I will personally mentor you. I have a one-on-one and a group mentorship program. You can write me an email. I will send you a form to fill, and then you will get one free consultation call with me. If you are serious, if I read the form and if you're qualified, I will give you one free consultation call where we will decide how to move forward and if this opportunity is for you or not. If it is for you, we will move forward with the mentorship and I will guide you step by step. So if you're interested, click the link below, reach out to me on any of my social media platforms, and I will talk to you soon.